Hello, a VCT or venture capital trust is an investment company listed on the London Stock Exchange. It's run by a professional fund manager. Names you might have heard of include Octopus, Foresight and Downing. And it invests in a spread of unquoted and often small companies that meet specific criteria set out by the government and HMRC. You might think this sounds risky, and VCTs are a higher risk investment. However, in order to encourage private investors like you and me to invest, the government offers generous tax incentives. So what do they invest in? Well, the simple answer, as mentioned earlier, is that a VCT typically invests in small companies. However, it's important to point out these companies are typically not one-man band startups, but established, often profitable companies in a wide variety of sectors including engineering, wine retailing, cake making, care homes and brewing. So what are the tax benefits? Well, when you invest in a VCT, you get income tax relief of up to 30%. For instance, invest £10,000 into new VCT shares and you could get back up to £3,000 from the taxman, providing you've paid or owed sufficient tax in the first place. The maximum you can invest in a VCT each tax year is £200,000, so you could save up to £60,000 in income tax. And inside a VCT, your money can grow free of capital gains tax. Typically though, any profit is paid out as a dividend. Crucially, these dividends are also tax-free. Historically, VCTs have paid very attractive dividends. Whilst a typical tax-free yield on a VCT is 5%, when you take into account the initial tax relief, this is more like an effective annual return of 7%. To put this further into context, to get the same amount from an investment with a taxable dividend, an additional rate taxpayer would need a yield of about 11.5%. Please note though, dividends are variable and not guaranteed. Tax benefits depend on your circumstances and tax rules can change. There are risks though, and VCTs are not for everyone. Small and unquoted companies are statistically more likely to fail than large ones. To keep the upfront tax relief, you need to hold your VCT shares for at least 5 years. And although VCT shares are listed on the stock market, they're not particularly liquid. Therefore, if you want to sell, you may not be able to do so quickly and will often have to sell at a significant discount to the net asset value. There are also restrictions on tax relief where investors acquire and sell shares in the same VCT within 6 months. You should take specific advice regarding the tax benefits if you are unsure. Finally, like all investments, VCTs can fall as well as rise in value, so you could get back less than you invest. Your capital is at risk.